So in June, we saw global equities rise around 1.5%, and this was the 5th consecutive month that we've actually had shares globally rise in value. Year to date, this brings us to markets rising around 12.5% and more than 90% off the lows we saw in March 2020. In terms of how investors were thinking during the month, it was very clear that there was a return to growth sectors or more durable, disrupting style of companies. So growth actually outperformed value by the largest amount we've even seen since this pandemic began, really showing signs that investors were questioning the length or duration of this further recovery or reflation trade that we've been seeing in markets. This meant that we saw sectors like IT, healthcare, and consumer discretionary really outperform, with the one exception being energy. So we are now seeing crude or oil prices rise to some of their highest levels since 2014, up around $70 a barrel. And this really comes from an incredible period where, if you recall, back in 2020, we even saw oil prices go as low as almost negative $40 a barrel. So there are a few distortions, but broadly, growth stocks were really in favor in June. In terms of the market's focus, it remains squarely on inflation, on interest rates, but also the global reopening. And we have seen this new mutated Delta variant of COVID really put some questions in people's minds around the speed that we will reopen as an economy. Hence in Sydney, and hence this video while we're in lockdown and doing this from home today. But if we think about the data that we did get in June, we did get an insight in terms of how inflation is actually coming through, particularly in the US, which is the economy that a lot of people do focus on. So we had the May CPI reported, so headline inflation rising 5% on a year-over-year basis. And under the covers, investors were really focused on this big debate around how transitory will inflation be. So we did see some of the more transitory components of inflation do the heavy lifting. Segments like used cars, which are now up on an annualized rate 170% in terms of price rises over the past 2 months. But then we did also see a few of the sticky components rise. So rents are starting to show some increases as well, creating confusion around how long or the duration of this inflation cycle. That meant all eyes were on the Federal Reserve, and we did get the minutes from the FOMC meeting where there was a little bit of disagreement in terms of how soon these rates may rise. So the dot plot, which really signals some of the committee members' expectations for rate rises, did show some of the members bringing forward their rate rise expectations by as much as 12 months. But then we had the chair, Jerome Powell, really talk down these expectations. What this meant for interest rates, which is what everyone is really focused on, is we actually saw yields in the US decline. So the US 10-year Treasury actually fell for the 3rd consecutive month, bringing it from its peak at the end of March at 1.74% to now be below 1.5%. This is really something that catalyzed, or was a catalyst for investors to think about how they want to be invested or positioned cyclically, and one of the reasons why we did see a lot of these growth stocks outperform. So as we move forward and think about markets from here, not too much has changed from the prior couple of months. Uncertainty remains very high in markets as investors really lack the new data points or decisive new information to make concrete and decisive decisions around how to position from here. Hence, volatility is actually at its lowest level in markets it has been since this pandemic actually began. What does that mean for us? It means we think investors need to be less focused on big, bold, decisive binary calls in terms of how to be positioned on inflation or the exact date that this reopening happens, but be more focused on individual stocks where we think that those companies in their own right have good prospects going forward from here.